Hello. In this episode, we are going to discuss managerial cost classification concepts. An organization's cost can be classified in different ways, depending on how information is needed by managers to make managerial decisions. We can classify costs by their behavior, by their traceability, by their controllability, by their relevance, and by their function. Cost behavior refers to a cost reaction to changes in the level of business activity. A fixed cost does not change with changes in the volume of activity. Rent expense. The amount of rent expense does not change as production levels increase or decrease. A variable cost changes in proportion to changes in the volume of activity. Material costs increase or decrease as the level of production goes up and down. A mixed cost refers to a cost with a combination of both fixed and variable elements. Utilities. Utility expense is a combination of a fixed amount for service of utilities, as well as utility usage cost. If we look at an organization's cost by traceability, we're looking at them by whether they are direct costs, costs that we can trace directly to a single cost object, material and labor costs for a product, or we can look at indirect costs. These are costs that an organization incurs that we cannot trace directly to a single cost object. For example, maintenance expenditures that benefit multiple departments. Maintenance expenditures cannot be traced directly to one department. It is indirectly traced. We can classify costs by controllability. The degree of control depends on the level of management in the organization. Managers at higher levels in the organization have a greater degree of control over costs than do managers at lower levels. Classifying costs by how they are controlled is an important part of assigning cost, assigning responsibilities, and evaluating a manager's cost control performance. If we look at costs by their relevancy, sunk costs are all costs that occurred in the past and they cannot be avoided or changed in the future. In making managerial decisions, sunk costs should be ignored. For example, a machine that was purchased 2 years ago at a cost of $15,000. That $15,000 purchase price is sunk because whether or not that machine is kept or replaced, that $15,000 cost cannot be changed. Relevancy and out-of-pocket costs. Costs that require a future outlay of cash. Out-of-pocket costs should be considered in managerial decisions. For example, if management is planning on buying a new machine for $25,000, the cost of the new machine is a future out-of-pocket cost, and it's relevant to the decision of replacing the machine or not. When we also consider relevancy, we have to keep in mind opportunity costs. Opportunity costs are the potential benefit lost by choosing a specific action from a couple of alternatives. Opportunity costs are always relevant in managerial decisions. If a company decides to produce a new product and gives up sales of $20,000 per year on an existing product in order to do so, the opportunity cost of producing the new product for 1 year is $20,000. It is very relevant to the decision about whether to produce a new product or not. Finally, we can classify costs by their function. Product costs. Product costs are costs incurred to produce a product. The direct materials, the direct labor, and what we call manufacturing overhead, or the indirect cost of producing a product.